Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long-short report covering all asset classes.
Good evening everyone. This is the 2nd of June 2021. So we are just starting another month. I'm going to be starting off writing my long short report as the month has ended. One direct observation which some may or may not have noticed is that the month of May closed with a bullish engulfing pattern on the monthly chart. So this is a very, very important setup from a candlestick point of view. Of course, when you look at candlestick charts and candle patterns, the importance goes up based on the time frame that you're looking at. And I always put it together with what my Elliott wave count or structure is and then give it importance. I don't just give importance to each and every candle because, when you really go down to a daily chart, you'll find lots of, individual candles and some of them are not, less relevant at some points of time. And you can't really trade each and every one of them. So you really have to look at, candle patterns as a good confirmation of what you're really reading into the market. And at the right time and place where you have to really look for them. And so you should know how to discount which ones are right and which are, to be ignored. So that's also important at lower time frames. But on higher time frames, most of them tend to occur at important, levels, either at a meaningful bottom or after a consolidation pattern. And that can sometimes give you a good singular signal or indication. So I think my sense, that the market would, break out and continue, gets a further heads up with the engulfing bull pattern, which also ends up giving you a high and low to deal with. So unless you really close below the engulfing bull structure, you don't have a trend reversal. And if it continues to trend on the upside, and many times these rallies end up going on for anywhere between 1 to 3 months. So that's what we are really set up for. The level of, negativity still is high. I understand the second wave pandemic, but the impact is definitely lowered. We've gone to one level of opening up, I think, in Maharashtra now, with allowing shops to open up. And definitely it's very, very hot before the monsoons, which are expected to be normal again, but very humid. If you can't really see, I've just taken a round around my society and I'm sweating like I've never before. I mean, I walk around and my head gets wet. That's how humid and hot it has become out here. We've even had some pre-showers, unlike before. So the heat has even got the early clouds showing up and dropping some water around, but still again it remains hot and humid. So within all of that, mildly opening up, not fully done, and expectations within a month or two that the vaccination drive will gain momentum. But that said, the June quarter numbers and data are going to remain bad. So economic data flow is not going to be positive. The market's purely moving on sentiment, the sentiment that things will open up and will improve, and then based on what is happening around the world, because where things have already been, US, Europe, all have been through their second waves early, they dealt with it on time. They're already opening up and seeing the impact. Like there's some news item today morning, which I tweeted of, Korean exports really jumping big time. Part of the pent-up demand story is going around and it's showing up even in European data. European data has been, jumping off to, new highs every time it gets reported over the last month. And similarly, the DAX has been making, the CAC also, which is Germany and France, have been making 52-week highs. So this is the environment you're in, despite the negative sentiment. I wrote about a chart of Brazil. Of course, you won't find it online, but let me show it here. It's really broken out and started to rally strongly among the, emerging markets that are really in play. And so Brazil is making a new 52-week high overnight. And all of this, I think, signals a generally improving landscape even across Asia. The Japanese market had its correction and initially it was a little volatile, but has finally picked up. Jakarta was seeing a lot of shakeout because of the domestic problems and the second wave of the COVID. It's made a nice multi-month double bottom, probably a fourth wave, and also should be picking up. So all of these markets are showing signs of picking up, and I think that momentum is going to then also rub off on India, which has been through a 2-month long consolidation phase from where we've now already started to make new all-time highs. And today, in fact, after what was looking like a correction, we hit the perfect support, which is the rising trend line from the low that we made earlier in the month of May. and that was at 14,450. I did my midday video update where we showed that level, and it exactly bounced back from that. So the market continues to hold on to key levels. That's the important part, and doing so, the momentum remains intact despite what remains is a lot of confusion among traders and investors. Some people are telling me everybody's bullish. They need to, market needs to knock some people off. And the fact is that every time I post a bullish view, there are 5 people who come and oppose it. And that really does not tell me the same thing. And I mentioned it in my last video that even on one of my Facebook promotions for 2 months, 90% of the posts were, that this is not going to happen, shouldn't go to a new high, market is rigged, blah, blah, blah. So those kind of concerns don't really tell me that this is a market that is, fully on the, fully overbought or, got too much participation. Sure, it's been a one-sided run, and for those who've been bullish and have made money, it will look like a dream run. But does that mean the market should top out? So there was a comment, I think, some time back by the RBI governor saying, this is getting bubbly, and he made some concerns about the stock market. And just today, I think on Twitter, we were having a discussion and some posts were there about, the Fed tapering. Again, you can't just look at, repo data and look for tapering. And they have done that so many times in the past that, if you just look at the history of the data, there's no correlation between reverse repos and, market reaction. So it's not a good data point to really go with, even though they may have done it early or whatever. That doesn't really matter. Its question is whether certain actions lead to certain results. And if they don't, then we shouldn't really read too much into it. That's my very straightforward answer to that. But it got followed up by the RBI talk that, there are concerns. The one thing I'll tell you, even though Fed people keep showing up concerns, this is not new. We've seen this even through the Yellen regime. It's finally what the Fed meets, they announce, and they've made it very clear that they are going to give you forward guidance of what they plan to do. They've been doing that for the entire last decade. And in that sense, they're saying they're going to keep rates down and not let them go up at least for another year. So I guess till their employment data improves to the levels that they want, they're really not going to touch rates. That leaves us only to reactions from the bond market, So, and even, if this reverse repo was such a big deal, then you would have seen a reaction either in the dollar or in the US bond yields. So somewhere it should show up. See, whenever you look at a data point, sure, you may not see stock market react immediately, but when you see such a big action by the Fed, the first place it will show up will be bond markets, currency markets. And if it's not showing up there, then nothing important has happened. Now, when it comes to, the RBI making a prediction on, market is bubbly, I don't know how many times they do that. And so I was responded with, one time when they did it in 2010, which was just the first rally recovery, and then it went into a correction, but then rallied again for many, many years. So sure, were they really concerned about that top as being a major concern? But that was not the end of a move. It was the end of, one part of the move, where definitely companies which were in debt, and there was a high inflation environment. And let me tell you, I thought the RBI prior to that, that announcement that was sent to me, and I don't know how relevant it was or loud RBI was about it. Inflation was running in double digits, 18% food inflation because of the stimulus we had done internally post the GFC. I thought the RBI would raise rates 50 to 75 basis points. They didn't do it. They did only 25 basis points in September of 2010. And following that announcement, the market took it so positively that the RBI wants, a low rate environment, and they're not, really doing enough for inflation. The stock market just rallied another 1,000 points. That's what happens, when what you say and what you do are so very different. So 1 month after that rally, if they come out and say, oh, it's bubbly, maybe they're just covering their back, I'll say, and that you got a correction was just by chance. Now, you can put the same thing in today's context. They've done, they've come up with the GSAP program. The market's taking that as liquidity positive, and they're well saying, okay, the market's gone too far. But does it really mean anything? And without looking at it in a context, global context, and also if you go by, such remarks made by various central banks over time, you'll probably not find a meaningful result out of it. There have been a lot of concern statements over time for US markets. It didn't work. Why didn't it work? Because there was too much liquidity. So we are in the same situation. So will it work or not work? I think I really go by what the market signals are saying. If there was a sense of concern in the market, it would show up somewhere. It can show up in the bond market, it can show up in the currency market, or it can show up in technical indicators. So there are many technical indicators which I discuss usually in the long short report. I'll share one now, which is nowhere close to being overbought, and that's the put call ratio itself. The PCR, which is the open interest put call ratio, is at the bottom end of its broad range when we actually look at where it is relative to the last 10 tops or bottoms that we were able to catch. And if it's here, and it was at the high, closer to the top end of the range sometime in March, when the market was actually starting to correct. So now it's not there, it's at the lower end, and this is where you don't really expect market tops. So even if you're looking for a top, it's probably some time away, maybe after this rally. So let it at least rally first, and then where is it in the larger wave structure would determine what will be the depth of the following correction. Too many people want to preempt what will happen next. They're asking, okay, will this end the 5th, and then you get the big ABC. Let us get there. There are a lot of subdivisions and a lot of room for extension counts to happen. There are also alternate counts between what Bank Nifty is doing and Nifty. So each sector may do differently. So there are many things to think about before you really, jump into that part of the story as to, what will happen next, and then miss out on what will happen now, because we can go on this narrative saying that, it's going to eventually crash, and then that means you become the perma bear for the eventual crash, which doesn't happen, and that doesn't really help you. So let's not now go that path. Let's look at what the opportunity is now. Let's ride it, and then when things start getting overbought, we look at what the opportunity on the other side is at that point of time. I think that's the right way to take this market, because it's been a pretty strong one. There are a lot of people who've sat on the sidelines thinking, that this is, not making sense. Some people are again coming around to thinking, well, we have to participate. So I don't think the end of euphoria has really happened. We'll see that going ahead, and by the time that happens, you'll have, a lot of mid and small caps which would have, gone crazy from, even where they are now. Like somebody noted again on a Twitter discussion that some mid and small cap stocks are just breaking out of their 4-5 month consolidation ranges, and some of them even longer term consolidations. So those look like beginnings. It's happening silently. The mid and small cap indices have actually broken out to all-time highs much ahead of the Nifty, and the broad market has just continued to move day after day throughout the month of May, which you can clearly see in the breadth or the advanced decline line. So if you just take a summation of advances to declines, it has been rising since last year and still not seen a dip, which is a pretty strong period to be in, because at the fag end of even a first wave of a bull market, I have seen this indicator cool off and start to decline, and it is still not done that meaningfully. So I think big observation there. We've not even got a negative divergence in the breadth on longer term. Shorter term, we do get them from time to time, which marks some of the near term highs, but that also is done and dusted. We're actually seeing breadth pick up right now, so we're not at a point where we really start looking for weakness in breadth. And when it shows up, then when we see divergences is when we start getting concerned. Now, should we concern about the 2-3 day divergence that you saw in the last 3 days between mid caps and large caps? No, that's too short term. Usually when you're looking for a divergence, it's got to be over a couple of weeks. Then it has some more relevance in terms of forming a medium term top. Now, apart from that, there was another discussion related to Bitcoin. So somebody said, well, Bitcoin's going to run up, and that's equities are overdone. And my straight comment to that, and I think discussed this in the podcast, I've discussed this before, but probably needs a pointer, that Bitcoin since 2018 has become very much a liquidity driven asset class, just like equities. So every time you've seen a correction, a deep correction in equities, like you got in 2018, in December or Jan, Bitcoin peaked. Then by end of Jan, equities peaked. In India, mid caps peaked in early Jan. And all of these asset classes corrected at the same time. And till 2020, post-pandemic, till you didn't get a pickup in equities again, Bitcoin did not make a new all-time high. It remained in that trading range. So that's a reflection of what's happened here in terms of move. I'll not go by, what has moved by how much percentage. So, maybe equities fell more. You can argue whether Bitcoin, because in Bitcoin in percentage terms tends to fall more. So it had a pretty steep fall. But on a 5-year basis, it might not look so big compared to equity. So that variation can happen, but the point being that when liquidity is moving out, now these asset classes tend to, in the near term or medium term, move in the same direction. So the counter question is that, well, recently it just crashed from 60,000 something to 32,000 or something, or maybe on some markets showed even a tick below 30,000. So why didn't it have an impact on equity? And my simple answer is that it's not having an impact on equities itself a reflection that this was not a liquidity event. So this was a normal routine correction. If this was going to be a major top in equity, I don't think this would have been a routine correction in Bitcoin. It might have ended up being something worse, and you might have actually seen a clear 5-wave decline at larger degree, and any rally in equities would only then rally with a B wave in Bitcoin, and eventually everything would fall in waves. Either something like that would develop. Bitcoin's already done an ABC correction. Unless it converts into 5 waves down and becomes a bear market for itself, I would tend to think that it was a routine correction, had no impact on equities, which is therefore even more bullish for both equities and Bitcoin. That's the way I read into it from a liquidity reading standpoint. I know there are difficulties for us to invest from India into it, so I don't really look at it anymore as a investment asset because we can't participate from India. But I definitely look at it as a liquidity indicator because it seems to have become mainstream, and a lot of investors now directly investing, trading on it on the futures exchange in the US since it's been listed there means that you have speculative money, which the same money, which hot money which chases equities, now chasing Bitcoin as well through hedge funds, through various structures that people have developed to do so and provide safety nets from the issues that Bitcoin has. And therefore when money runs from one asset, it tends to run from everywhere else, and that usually shows up. And if it's not that, then probably it's not a major event. That's I think my short takeaway. Now I would also want to I had written a pretty long post on behavioral finance issues on Facebook, and I think I posted it on Quora, and I was really talking about two layers which tend to happen. And this is my experience, having worked even in broking for a long period of time. Clients come up for calls, and your job is to put out calls. There are various types of behavioral problems that you face. For example, even if you have a good performance, okay, so now I'm taking a completely different stance like the one I wrote, where I said the analysts themselves face a behavioral finance problem, which is their own issues on trying to show performance and so on. But let's say, because there are good and bad analysts, so let's say you got a good one and he's pretty good. But pretty good also means 60 to 70% strike rate in terms of number of calls going right, okay, and still 30-35% going wrong. And when you follow trades of that nature, even then I have seen clients cannot follow those trades. Why? Because there's a behavioral finance problem again. The expectation is that while at the back of your mind some trades are going to go wrong, if 4 trades go wrong in a row, which is part of the 60-40, 70-30 breakup, because it's not going to be 70-30 doesn't happen as right, wrong, right, wrong, right. It's always random. So sometimes there are bad trades that can show up in a row. And moment that happens, because it's a bad month, and usually a lot of stops get hit simultaneously, that's it. People just walk out and leave on you. So nobody's looking at your 1 year, 6 month performance. In fact, people will wait for, let's watch him, let it be right. And after 4 months or 5 months of, somebody being right, they'll actually bet exactly when it's going to go wrong. And then they'll start trying to choose between, let's follow this guy who works at this broker and that guy, that broker, and then they'll try to outguess who's going to go right. So these are other complete layer of issues. So one is issues that you may face yourself, because behavioral finance is a large subject. And 2 or 3 of the biggest issues that individual investors face involves things like, I'm just mentioning some of the biases, if you know about them, like mental accounting, recency bias. These are the 2 most common that I've found. There's also, confirmation bias and herding. Herding, of course, we all know, which is crowd psychology. But confirmation bias is like, expecting to know. If you think something is going to happen, then you want to talk to 4 people who say, yes, that's going to happen. And if somebody says no, you'll probably not listen to him. So that's confirmation bias. And the other one which plays a lot of role is recency bias, because you always look at the most recent top, bottom, high or low made, and then associate your actions with that. So if you bought something at 80 and it falls to 60, suddenly it looks like you bought too high, and moment it goes back to 80, you want to get out, and then it goes to 120. So this is the oldest thing you face in investing. I faced it way back in my first trade, and it's a tendency of a lot of people. So getting over these behavioral biases, which is your own, okay, so getting your own psychology in place, understanding how you behave, and then managing that, versus not dealing with the not knowing that you're dealing with behavioral finance problems of the person you're really working with. So that's completely second layer of problem. And if you put 2 and 2 together, problems 1 with problems 2, the net result is usually a disaster. So what I was really trying to highlight is that in the best interest of individual investors, they should seriously learn how to execute, and while this may in a sense be pushing people to learn, and since we do training, it's something you really have to think about. I mean, I believe in self, because so that is one of the reasons why we don't really do and I probably never do advisory services. That's my thought as of today, is because managing other people's emotions and dealing with you got enough shit to deal for yourself, then you need to deal with others. So having been through everything that I've just spoken about, I feel it's just not worth it, because the end results could be far better. If you know how to do it, you might as well do it for yourself. So the best I can do is share information and share opinions, share analysis. What people want to do with it is part of their own behavioral finance problems, which you can solve by having good knowledge of the market science, having a method, process in place. And that's what we try to do with our mentorship programs. Now, having said that, one last point that I'll leave with, when you have a winning streak, you face a unique problem. People start telling you things like the market started to listen to you, like as if you're moving the market, but which is completely untrue, because it's never the market that is listening to you. It's you who's listening to the market, and the people who follow you are listening to you. So they think you're the market's listening, but actually it's you listening to the market, because good analysis is all about listening to the market. You need to listen, watch, see what it wants to do, and try to figure out what it wants to do. And if you are able to do that, then your strike rate is higher. When you're not able to do that as often, your strike rate is lower. And there are also phases where you will tend to have higher strike rates and higher accuracy, and there are phases where it tends to drop a little bit, especially when there's a lot of zigzagging in the market. It's natural that strike rates drop, unless of course you are able to predict that a zigzagging period was coming. Then you can change your strategy to fit the zigzagging behavior. So I know how to change to a zigzagging behavior. The only time it would go wrong is if I don't really predict it's going to be zigzagging, and I would not do that prediction simply because I may think that there's a larger trend in force, either up or down, which I want to play, and then I would tend to ignore the zigzagging during the shorter time period that's happening. And the way I'll deal with that is, moment I find that trades are beginning to go wrong, I would actually reduce my position size. So when you have a trending market, so if I was on a call giving buy and sell recommendations like I did say at Sher Khan, I would increase the number of trades I would put out when the market is trending, and reduce the number of trades when it starts non-trending. So even then, so when non-trending, those trades would get hit, but at least you had fewer of them. And then when it's trending, you try to do more so that you actually improve the overall ratio at the end of a period. But again, the problem from a client perspective will always be that if I increase the number of trades, how much money can he really deploy? Because your portfolio is X, you can probably take 5 positions or 10 positions in that portfolio. And if it's a trade, if it's F&O, it's limited by capital. And so you can't go beyond a point. So on paper, doing that kind of thing, increasing, reducing trades, can be done. If it's a large book, you can do it. Okay, if it's a small book, then you need again a different kind of approach and strategy, where you need to be right more often than not at the beginning till you really expand your book. And if you have to do that, you have to learn to ride what are high probability trades, and essentially show up in either third waves or C waves. So you look for triangle patterns, you look for very good retracement setups, which you can play with higher certainty, so that you can build that capital and grow it in the initial stages, even with a smaller number of positions. Once you have size, you can play around with the idea that you increase and reduce. But even if you have, you can go up to 5 positions. I think there's enough room to reduce that to 2 positions. So it need not be like a book. So even when I ran a book at Sharekhan, we always put a limit, like on momentum trades, I put a limit of 5, which means we'll never put out more than 5 trades. So it wouldn't be too many calls. The only thing you can do is, when I say that you'll have more number of calls, is that one gets booked out, you have another one in place and another one in place. And at the other time, you'd probably just reduce it to 2, 3 and monitor. Of course, there's always the pressure to put out more when you're in a broking concern, because there's a revenue angle to it. But that's how I managed it. That's the pressure you have to deal with if you really want to run it in the right way. And so that's what people need to learn to do, even on their own book, increasing and reducing trades based on the type of market that you're dealing with, and then figuring out how to execute in the right type of market using the right tools. Searching for third waves is part of the deal. If you're starting really small, looking for those only the high probability trade setups which come after certain patterns, or which come after certain retracements and at certain points in the wave structure. And then as it grows, you'll be able to do it on more often on a day-to-day basis. Once you have a book where you can expand at least to 5 positions, then it becomes much easier for you to really do. So that's, I think, what I'll leave you with. A lot of thoughts on different parts of trading and execution, along with psychology and the markets, which I continue to remain bullish on. See you next time.